side. The comic on the side there, when you talk about any type of tax law or farm taxes, but you see the picture of Superman there, and he says, just because I can leap tall buildings in a single bound doesn't mean I can understand the tax code. And I think that's pretty true for most people. In the tax code, there's a lot of gray area in it. There's also opinions. Not everybody agrees with IRS sometimes, and sometimes those people win, sometimes IRS wins. But I'm here to kind of give you a brief overview about some things to think about when you're talking about beginning farmers or small farmers. But really, all this would apply to any farm operation. I'm not sure how many farmers that are online that are what we call small farmers or just regular farmers. But again, things would apply to any farm operation. So the first thing I'm going to talk about, when you talk about small farms, what's a hobby farm, for example? And the difference between an actual farm and a hobby farm, a hobby farm would be one that somebody is doing because they just like the idea of doing it. They're not really in there for profit necessarily. But if you are considered to be a hobby farm and you have losses on that farm operation, those losses are going to be no more than the income that you have. So you really can't generate a loss on your tax return. Any deductions are going to be limited to the amount of income that you do have. And I get questions from farmers sometimes. They got a couple goats, a couple sheep. They want to put up a shed, for example, to house those animals, and can they deduct the cost of doing that? Well, again, if you're just doing that for personal purposes and not necessarily make a profit, you're not going to be able to take any deductions on that shed, for example. Another guideline that IRS has is that not to be considered a hobby farm, you need profits at least 3 out of 5 years. If you're less than that, you could be considered a hobby farm. If you're in the equine business, then it's 2 out of 7 years you got to show a profit. Now, again, that's not a hard guideline. We'll look at some examples here in a second. But if even though you maybe have losses all 5 years, but if your intention is to make a profit, if the activities carried on in a business-like manner, are you depending on income for a livelihood? Are losses beyond your control? Maybe you had a drought or a derecho come through or a tornado and you had no income that year. Are you trying to improve the operation so that you do make a profit? The people you work with, your advisors, for example, and you yourself, do you have the knowledge to run that operation? Were you successful in the past with a similar activity? Are there profits in some years? Are there expected future profits? These are kind of the 9 factors that IRS does look at to consider whether or not you are a hobby farm or not. Again, I've had some farmers I know of that, they've had losses maybe for 10 years. But again, nobody stepped in and said that they are a hobby farm. The important thing is to keep records. If you keep good accounting records, if you go to meetings, either through Extension or some other entity or business to help improve your operation, seed corn meetings, for example, keep records that you did attend those meetings. And again, that does show that you're trying to improve the operation and make profits. But the important thing here is to have those written records and, have dates on the calendar. For example, you attended the meetings, what they were about and so on. So even though the profits 3 out of 5 years is somewhat important, if you can justify that you were trying to operate the business as a profit, then you will not be considered a hobby farm. Things to consider for the first year business. My recommendation is that if you're first starting up, and this is hard sometimes, but try and show income in that first year. And I say that because if you have no income, and this is your first year of startup in the business, IRS can step in and disallow those expenses for that startup phase. They're not disallowed entirely. It just means that you can't deduct them in that first year. You may have to amortize them over 5 years. I personally have never had this happen, but I have had a couple phone calls over the years where people were being audited by IRS, and they did disallow those expenses. One of them was a dairy operation where the guy had purchased the dairy cows, he'd purchased feed and so on, but wasn't going to start milking until the following year, so he had no income. And the IRS was saying, well, you have to amortize those expenses over 5 years and not take a deduction in that year of the startup. So just something to think about, something to consider. But again, the way to get around that is try to show some type of income in that operation in that first year. You're probably going to be purchasing some assets for that small farm operation or business. And maybe it's machinery, maybe it's buildings. If it's a livestock operation, and maybe you purchased, some cows or sows or goats or whatever it may be. But those assets, they can be depreciated, which creates an expense. And again, I'll talk about some of the different methods here a little bit later. If you're going to buy farmland, and maybe this is not new news to any of you online, but I have had people call me before over the years. They bought farmland thinking they could deduct the cost of that farmland. Well, farmland is not a depreciable asset. It's not deductible. But what you can do if you're buying farmland, if there's buildings on that farm, if there's field tile, if there's fences, if there's grain bins, you can isolate those out, put a value on those, and you can depreciate those assets that are attached to the farmland. But the bare land itself is not a depreciable or not a deduction in an operation. If you buy a piece of farmland with those buildings on it, you're going to take the value that you paid for that farm, and you're going to deduct off of that value the buildings, field tile, and so on, and then the remainder, it's what's going to be the basis in that farmland. So if you ever sell that farmland in the future, that's going to be your basis, and whether you have gain or loss on that in the future will be determined by that basis when you originally purchased that farmland. Also thinking about that hobby farm, just a quick thing here. If you happen to have children that are in 4-H and have livestock, for example, that income that they have really is reportable income, but they do not have to pay self-employment tax on that income if they sell that livestock. I know how it usually works that, the livestock may get run through actually the parents' business, but if the livestock does belong to the children and they sell that livestock, again, they really should file a tax return reporting the income, but again, they don't have to pay self-employment tax on it. And again, if you're a farming business, you file that information on what they call a Schedule F on your tax return, and you're going to pay income tax on any of the profit there, plus self-employment tax, which is like Social Security tax. So about 15.3% on that net profit is going to be paid in for what they call self-employment tax. But again, 4-H assets or livestock that are sold, they don't have to pay any SE tax on that. It is somewhat important for those, if you have children that are in 4-H, if they think they're going to be farming in the future, for example, and maybe they want to go to the Farm Service Agency to obtain a loan to buy a farm or more livestock down the road, they're going to require that that person shows that they've actually been involved in a farming operation. I believe it's for the past 3 years. So if they have 4-H projects and they've been selling those, they'll have a Schedule F to show that the FSA office that they have been involved in farming in previous years. Other thing to think about for farming operations, and this is, for farm operations here in Iowa, if you happen to be out of state, you'd have to look at your own state laws to see what they've put in place for this. But agriculture operations for certain things that they purchase are exempt from an Iowa sales tax. And what they call agriculture here, this is kind of a list. It's not a complete list. I think Lauren is going to post or has online the actual Iowa Revenue Department Farmer's Guide to Iowa Taxes, which has the complete list. But if you're raising crops or livestock for market, flowering, ornamental, vegetable plants, aquaculture, commercial greenhouses, nurseries, orchards, dairies, feedlot operations, those are all considered to be agriculture entities. And the things that you buy for those entities may be exempt from Iowa sales tax. Not agriculture production or considered agriculture production is beekeeping, raising mink, non-domesticated fowls such as ostriches or emus, for example, land that happens to be in the Conservation Reserve Program. If you buy a farm that's been timber, for example, and you're going to clear that, it's never been cultivated before, clearing previously uncultivated land is not going to be considered to be agriculture production. Building farm ponds, construction of machine sheds, confinement facilities, if you're in that business of doing that, that is not considered agriculture production. So think about if you're involved in agriculture production. Purchases are usually exempt if used in what they call direct ag production. And this gets a little fuzzy in some areas. But again, if you're purchasing fertilizer, chemicals, seed, feed, bedding, veterinary medicines, fuel used for heating, electricity used in production agriculture. So if you're heating farrowing houses, for example, or finishing houses, the electricity used in that production is exempt from the Iowa sales tax. If you're buying parts to repair machinery, for example, they're also exempt. Buying farm machinery is exempt from Iowa sales tax. So if you're buying tractors or mowers or balers or grinder mixers or whatever, those are exempt from sales tax. Again, repair parts, for example, if you have to overhaul that tractor and you got to put pistons and crankshafts in it, for example, those repair parts are exempt from Iowa sales tax. But if you're going to be buying spark plugs, for example, or belts, some of those things, they are not exempt from Iowa sales tax. Specifically designed hand tools for whatever enterprise that you may have can be exempt. I was trying to think of what those might be, but if, for example, if you have a cattle operation and you purchase an item, what they call a calf puller to help pull calves, if they happen to be not coming out like they should be, I think that would be specifically designed, for that cattle operation. But if you're buying crescent wrenches and hammers and open end wrenches, that type of thing, again, those would not be exempt from the Iowa sales tax. So again, some tools are exempt, some tools are not. And again, these are not complete lists either, but those would be in the handout for the Farmer's Guide to Iowa Taxes. If you happen to purchase an item and you pay Iowa sales tax on it, can you get a refund? And the answer is yes. Again, I think Lauren maybe has posted this online, but that form you would file, and this is just a partial picture of it, but it's called an Iowa 843 claim for refund. So you can file that and get your refund back. It's a 2-page document you have to fill out. It's not too bad to fill out, but for example, I just had a call this week where a person had put a generator in for their farm operation, and he had paid the sales tax on it. Well, again, the generator used for his farming business would not have to pay sales tax, and so he can file this form and get that refund back, which was about $500 some, and get that back. A few years ago, I wrote an article about electricity that's used in the production of farm agriculture products. You don't have to pay sales tax on. And again, several people called me later on, thanked for the article, and they went out and looked at all the motors and figured out how much electricity they were using for running fans and so on. And they filed this claim for refund and got the refunds back for paying sales tax on the electricity. Some farm operations maybe will have 2 meters set up, maybe one for the house and one for the farm operation, which makes it a little bit simpler. But this is the form you would file to get this back. Had another farmer that had called me, actually has a cattle operation, and he had bought a couple of horses. Well, he was using those horses in his business, and when he bought those at the auction place, they charged him sales tax. So again, he filed the refund and got the sales back on those horses. Now, if you're using those horses just for pleasure riding, again, there would not be an exemption for that, for example. When you think about your farming operation and thinking about what do you do for taxes, for example, and again, this is going to be true for any farm operation, not beginning farmers or small farm operations, but you should be thinking about what tax bracket are you going to be in when you file your tax returns. This is just not the farm income. This is your total taxable income. So if you're working off the farm and you have wages, your spouse is working off the farm and they have wages, and plus you got some farm income on top of that, then here are the different tax brackets. So what this is saying here, that if you're married filing jointly, which again, most married people would file, if you're up to $89,450, you're going to pay 12% on a good portion of that taxable income. If you go over that, the amount over the $89,450 is going to be taxed at 22%. So it's a stair-step process. It isn't just one rate for all of the income. You figure out what income falls on every bracket, and that's the percentages that you do pay your tax on. Some people will try to plan their operations maybe to stay in that 12% bracket. Others maybe have too much income, they're going to have a portion that be in the 22%. So it just depends what your other income may be along with your farm income, because you're going to add your farm income to any other income that you may have when you file your tax return. Again, the farm income is going to be on the Schedule F form when filing your tax returns. This just shows there are different brackets depending on whether you're married filing jointly or unmarried individual or surviving spouses. Again, the income actually is about half what it is for married filing jointly to still stay in those same tax brackets. Something else to consider if you happen to purchase farmland, for example, and then sell it later on, there's what they call capital gains rates. And it applies to any gain on that farmland. Or if you had raised cows, for example, and you calve those for 2 or 3 years and you sell those cows, again, that's going to be capital gain income, not on your Schedule F, but goes on what they call a Form 4797. The thing to think about here is that for capital gains rates, if you can keep your total income, so it does not exceed, for married and filing jointly, $89,000 or less, there's zero capital gains tax on that capital gain income. So if you had, for example, $50,000 of wage income and you sold some raised cows that were $20,000, all that's going to be under the $89,000. You'd pay no tax I'm talking about federal taxes. You pay no tax on the gain on those cows. And I keep saying raised cows because that would be considered to be capital gain income. The thing that some people don't think about, they think if they sell any farm machinery or they sell some purchased cows, for example, that all that income is going to be capital gain income. And that's not necessarily true. If you have bought a tractor and that tractor is all depreciated out, when you sell that tractor down the road, any recapture of depreciation is going to be ordinary income, subject to whatever bracket you fall into. Only if you sell that tractor for more than the original purchase price, that portion would be what they call capital gain income. And the same would be true if you purchased cows. If you purchase those cows, and those cows are going to be depreciated over 5 years, if you sell those cows in year 6 or 7, for example, down the road, any recapture depreciation is going to be ordinary income taxed at those rates, and only if you sold the cows for more than the original purchase price would you have capital gain income. So something to think about down the road, but some people think if they sold any assets, it's all capital gain income, and that's not true. Some of it could be ordinary income. Just got this slide tossed in here, but again, if you have a couple options when you're thinking about your vehicles. If you purchase a pickup for your business, you can either take the actual expenses on that pickup as a deduction. You can depreciate that pickup. You can write off the gas and repairs as expenses. Or if you don't want to keep track of the actual expenses, you can just take a mileage number. And for 2023, that was 65.5 cents in 23. So you keep track of your business miles, and then the business miles times 65.5 cents would be your deduction on your Schedule F for the use of that pickup, for example. IRS does say that if you're ever audited and checked, you're supposed to have a logbook to show how many miles you drove with were business and how much of that was personal. Personally, I've never had them ask for one, but again, they could. I don't think that they'll get too upset if you only have one pickup, for example, that you're taking as a business. But if you're taking your pickup and trying to take your personal vehicle, both of those as business, they would probably argue about that and thinking that that car probably, most of that's probably going to be personal use. Standard deductions. These were raised 2 or 3 years ago, but if you're married filing jointly, for example, in 2023, filing those tax returns, you get a standard deduction of $27,700. That's a pretty good deduction that you have. It goes on your 1040. It does not reduce your Schedule F income for self-employment tax purposes, but it does reduce your income for federal income taxes. Some people say, well, I may want to itemize, and itemized deductions go on a Schedule A. And if you're going to itemize, those itemized deductions include money that you give to charities. Your Iowa income tax can be an itemized deduction up to a certain dollar amount. Some of your medical bills could be itemized deductions. Your property taxes on your personal residence is an itemized deduction, but you have to exceed that $27,700 before it does pay you to itemize. So again, most farmers probably don't itemize. They probably just take the standard deduction. Now, this is going to change in 2026, I believe. So they're going to reduce this standard deduction. So once they make this change, it may be better, again, to go back to itemizing deductions. But that's what it is currently. Something else to think about, if you are a farming operation, your health insurance, if you're having to purchase your own health insurance, again, that goes on Schedule A as an itemized deduction possibly, or it can be included as a adjustment to income on the 1040. But again, you have to have a positive Schedule F income in order to be able to take that as a deduction on the front of the 1040. If you want to make it a business deduction, if you only have one employee, you can set up what they call the Section 105 plan. You can make your spouse the owner of that policy. It can be a family policy for health insurance purposes. And then that actually becomes a business expense because you're going to pay your wife a salary or your spouse a salary, and it becomes a business expense and goes on your Schedule F and can reduce your self-employment tax. But that's only if the spouse is the only employee that you have. If you have more than one employee, then you have to start carrying the group policy, and it doesn't work out nearly as good as having that Section 105 plan. But that has been around for several years. And again, a lot of farmers do utilize that because again, it reduces your self-employment tax as well as your income taxes when you do that. These are just the personal rates for Iowa. You can see here that again, they are graduated rates. Most people probably fall in that 5 to 6% ranges. In 2000, and I believe I think it's either 25 or 26, Iowa is going to have a flat tax at 3.9%. So these are going to be changing in the future years if they can make it work and go to this flat tax no matter what your income is. But this is what it currently is for 2023. Section 179 expense. This is an election that farmers can take, or I guess any business can take actually, if they're going to be purchasing depreciable assets. So again, as a startup business, as I mentioned earlier, you may be buying some machinery to run your operation. Could include even a pickup, for example, or maybe you're buying some breeding stock, whether it's goats or sheep or cattle or swine. But what this does, it allows you to take a fast write-off of those assets you purchased. The maximum for 2023 is $1,160,000, which seems like a lot of money, and don't get me wrong, that is a lot of money. But if you are a large farming operation, again, buying a combine can be up to $1 million. If you're trying to get into contract feeding for livestock and putting up finishing houses, again, you could exceed that, without too much trouble also. But that's the biggest deduction you could take. But the thing with Section 179 is that you can pick any dollar amount you want to on any qualifying assets. So maybe you only want to take $25,000 on an asset you purchase. If you spent $50,000 for it, you can take $25,000 on that one asset and depreciate the other $25,000 over possibly 5 or 7 years, depending on what the asset is. So you can pick the dollar amount that you want to use, and it's a very flexible and a very good deduction that businesses do have. This is a permanent part of the federal tax code, or as we like to say, it's permanent until Congress decides that they want to change it. But it used to be where you didn't know from year to year what it was going to be, but it has been made permanent. It's indexed for inflation every year. So in 2024, it will be a little bit higher than what it is now. If you happen to purchase a lot of assets over $2,890,000, for every dollar you exceed that on your assets, you got to reduce to Section 179 dollar for dollar. So it can get phased out if you do purchase a lot of things. Again, probably most beginning farmers, small farmers operation won't have to worry about that, but it can get phased out if you spend a lot of money in 1 year. Again, it needs to be a qualifying business, farm operation, for example, and the assets have to be used more than 50% in the trade or business. So maybe you buy a pickup, for example, but you're only going to use it 30% in the business, so you could not take Section 179 on it, but you still could depreciate 30% of that value if you wanted to. Something to think about too for small beginning farmers. Sometimes that they're working with their parents, or possibly maybe parents have passed away and you've inherited some assets from them, some machinery, for example, or you've purchased some machinery from your parents. But if you're getting assets from a related party, then you cannot take Section 179 on it. You can depreciate it, but you just can't take the fast write-off. Related parties in this example includes spouse, lineal descendants, but brothers and sisters are not called related parties. So you could buy something from your brother or from your sister, and you could take Section 179 on it if you wanted to. So, but something from your parents, for example, you could depreciate it, but you could not take the fast write-off. It's also limited to the taxpayer's aggregate net income from the active conduct of trade or businesses, including wages you might earn. So, for example, on your Schedule F, if that's your only income, if it happens to be a loss or at zero, you could not take Section 179. Or let's say you got $20,000 of profit on the Schedule F before Section 179, and you did buy some assets, you could take enough expense there to get that down to zero if you wanted to. But you cannot create a loss or what they call an NOL by taking Section 179. So there are some drawbacks to that a little bit sometimes. If you happen to take too much Section 179 and aren't aware of it, what you can do, or what will happen, is that whatever you could take in that one tax year will carry over and be there for the next year to use if you happen to take too much. Here are some what we call the class slice, a different property. When we talk about Section 179, for practical purposes, any property that's 15-year property or less, you can take Section 179 on. So that includes drainage tile, barn lots, grain bins, fences. If you get into orchards or whatever, also qualify. Machinery, both new and used, for example. Automobiles and pickups, although there are some limits on how much you can take. Breeding livestock, so sows, goats, cattle, dairy cows, for example, all eligible for Section 179. But you cannot take it on farm buildings that have multi-uses. So a shop or a machine shed, for example, you can depreciate that over 20 years, but you cannot take Section 179 on that asset. But if it's a confinement building, confinement buildings like a contract hog building, for example, that's going to be a 10-year property, and you could take it on a confinement building because that's considered to be a single purpose, or a milking parlor for dairy, for example, would also qualify as a single purpose, but just not an ordinary building for storing hay or machinery. And again, depreciate over 20 years, but you can't take Section 179 on it. Then there's what we call bonus depreciation. It kind of acts like Section 179, but with bonus depreciation, you cannot pick the dollar amount that you want to use. In 2023, it's 80% of the cost of the asset you can write off. And you either got to take 80%, or you elect out of it and you don't take any bonus and you just depreciate it over the life of the asset. So again, it's mandatory that you take it unless you elect out of it. So on your tax return, you're going to just file a notice on the tax return that you're going to elect out of bonus depreciation if you do not want to use it. The thing that's nice about bonus depreciation, I talked about that machine shed, for example, that you cannot take Section 179 as a fast write-off, or that shop, for example, but you can use bonus depreciation on it. So you could put up a new machine shed in 2023 and write off 80% of the cost of it in 1 year if you wanted to. So that's the nice thing about bonus depreciation. Also, if you happen to be a landlord and renting out your property, and you want to put, that landlord owns farmland, but wants to put tile in it, he can't use Section 179, but he can use bonus depreciation to write off 80% of the cost of that tile. So it can be used on rental property where you can't use Section 179 on rental property. Again, it is automatic, and you have to elect out of it if you do not want to use it. It is on a phase-out schedule. I think the next slide here shows the phase-outs, but it's 80% in 2023. It's 60% in 24, 40% in 25, 20% in 26. In 27, there's no longer any bonus depreciation unless Congress decides to extend it or reinstate it. We just don't know what will happen down the road with this. Again, it was put into place to stimulate the economy, so the businesses would actually, buy assets, stimulate the economy, because they could get a fast write-off for purchasing those assets. I always tell farmers, especially, most farmers hate to pay taxes, so they may buy machinery, for example, use Section 179 or bonus depreciation to get their income down. But down the road, you still got to pay for that asset. So it isn't always good business to write off everything that you're purchasing. Sometimes it's better to take just the regular depreciation and spread it over future years, and it may do you more good in future years than it does in that 1 year. Again, you can take bonus and Section 179. If you do that, there's an order that you do it. For example, if you purchase a tractor, let's say for $50,000, you could take $20,000 Section 179. That leaves $30,000 left. You could take 80% of that $30,000 if for bonus depreciation, and then to depreciate the remainder if it was a used tractor over 7 years. And there are depreciation methods that you can use. Makers is kind of the go-to one that we have, but with the makers, there's what they call the 200% declining balance. There's also the 150% declining balance you can use. There's also straight line depreciation. So makers is the fast method. You take more depreciation in the early years, less in later years. A straight line, you're going to take pretty much the same amount over the life of the asset. So again, if you use the 150%, again, you take more in the first years, but you're going to take less in later years, but not quite as much as the 200%. So lots of different avenues out there if you're trying to manage your income by using depreciation. I also should have mentioned on bonus depreciation that it also goes by class life. So if I buy a tractor, for example, and it's a used tractor, and then I buy a planter that's also used, those are 7-year property. And you can't take bonus depreciation on the tractor and also not take it on the planter. You have to take it on all assets in the same class life. So you're, again, maybe limited to what you're trying to do using bonus depreciation. That's unlike Section 179. I can pick a given piece of machinery, just one piece. If I want to take it on that one piece of machinery, I can take it on different class lives. You don't have the stipulations you do if you're going to use bonus depreciation, but it is by class. But if I bought again, that used tractor, that used planter, I got to take it on that 7-year property. But if I put up a confinement hog building, that's going to be a 10-year property. I wouldn't have to take it on the hog building if I didn't want to. That's a different class life. So again, lots of things you can do to help manage taxes by the different assets that you may end up purchasing. If you happen to be buying farmland, this has come about just the last few years, but with the high price of farmland that we have today, there's what they call a residual fertilizer deduction on purchased farmland. This kind of started up in Minnesota, actually probably 15, 20 years ago. But if you're paying a price for that farmland that's above the market price because it has good fertility on it, and you can prove that you're paying it because of the fertility, you may be able to amortize or depreciate that fertility over, let's say, 5 years, for example. So let's say you bought a farm for $15,000 an acre, and you say, well, $500 of that was because of the fertility. So take that 500 times the acres that you have, and then depreciate that over 5 years for the P&K values that's in that fertility, and you get a deduction. Now, again, the hard part here is that how do you prove, what that fertility is? So this is just some examples here, but try to get an agronomist out there to run some tests and say, here is the fertility that was on there. This is why you paid, this price for it. But again, if the farm right next to it sold for the same price, how do you prove that you paid extra for the fertility on that farm? Also, are you not going to fertilize it for the next 5 years and use up that fertility that did carry over? So to me, I know farmers are doing it. So far here in Iowa, I've not heard of any issues with it. Up in Minnesota, the state of Minnesota started auditing these farms, and a lot of them, they disallowed it. Again, like a lot of things, people were getting greedy and trying to write off a couple $1,000s an acre, and maybe it should have been $250 to $500, for example. So if you're going to do this, just make sure you jump through all the proper hoops and have the records to back you up. It may still get disallowed if you don't want to fight it too hard, but you probably will avoid any penalties if you do have the reasons why you did take this residual fertilizer deduction. So I put it out there because I do get a lot of questions about it anymore. So if you think about, again, any farm operation, whether you're big or small, what do you expect your income to be in future years? If you're going to have more income in future years, maybe you think about, well, I don't write off so much here for depreciation this year because I can use it more next year. Or maybe I don't prepay expenses this year. I use an expense next year. Again, farmers, to what I not say avoid taxes, but to minimize taxes, you are allowed to prepay certain expenses for the coming year. So I'm here in December of 2023, and I look at my tax return, projected tax return, and say, hey, I've got way too much income, but I'm going to be farming next year. So if I need seed and fertilizer and chemicals, I can prepay for those items in December of 23 and take it as a deduction in 23, even though I won't use them until 2024. Again, you need to be prepaying for actual expenses. You need to have some invoices saying I bought so many bags of seed, so many tons of fertilizer, so many gallons or whatever of chemicals. You just can't make a deposit at your local co-op or whatever and say, I'll figure out what I bought sometime in January. It needs to be an actual expense that you're using. You're even allowed to prepay up to 12 months of rent. Of course, your landlord may not like that because he may get stuck with 2 incomes in 1 year. So you need to visit with them if that's something that you are thinking about doing. And again, prepaying expenses, you got to be careful about related parties. I just had a question last week with a father and son deal. The dad's running his farm to his son. The son figured out that he had too much income, so he was wanting to prepay for rent for 24, so he could deduct it in 23. But again, that doesn't work if they're related parties. The IRS says you need to match income and expenses between the related parties. So in other words, if he's going to prepay the rent, then the dad's going to have to call it income also, because unrelated parties, you could prepay the landlord for rent, mail the check on December 31st. If he's a cash basis taxpayer, then you're going to take the deduction in 23, but the landlord wouldn't have to report it till 24. That's when he receives the money. But you can't play that game with related parties. So things about for tax planning strategies. This is just getting into some other things to think about. If again thinking about tax planning, I talked about that standard deduction. Also think about if you have children, because you get child tax credits. But again, you got to have the income to get some of those credits or that deduction. You should always plan, if possible, to have enough income to use up that $27,000 standard deduction. If you have children, you get $2,000 as a tax credit for each child that you have. So again, have an income to use up those credits if possible. You can't carry those unused credits over. You can't carry that unused standard deduction over. It's called the use it or lose it rule. If you can't use it that year, it's just gone. So that's some tax-free income that you could have. So again, trying to plan your income so you have enough income to use up all those government deductions that the government does give you. We talked about, again, some of these here, reducing your just a gross income, prepaying expenses. You can contribute to retirement plans. If you have, again, earned income, you can put money into IRAs, SEP plans, some 401ks, and so on. You could make gifts to grain. If you're trying to reduce your income, think about this. If you're writing checks out to your church, for example, but again, you don't have enough to itemize. I'm not saying you shouldn't continue to do that, but from a tax standpoint, writing that check to the church is not doing you any good from a tax standpoint because you're not itemizing. But if you make a gift of grain to that church, you're not reporting that grain as income, so you're not paying any taxes on it. The church gets the grain, the church sells the grain, so they get their money by selling the grain. And again, they've got their money, and you don't have to pay tax on the income nor to write them out a check. So, and again, I have a lot of people that do this. You have to visit with your church and, with their board or trustees or whatever to make sure that they're going to handle this. And the proper way to do it, you just can't take in a load of corn to the elevator and say that this is, make the check out to the church. You have to take the load of grain into the elevator, say this is the church's grain. They're going to make out a receipt for the church. Somebody from the church calls and say, hey, I want to sell my grain. And usually wait a day or two would be the best. But again, it works out very well. Also, farm operations, if you've been farming for 3 or 4 years, you can use income averaging. And farmers are the only ones that are allowed income average. If you have a very high income in 23, for example, and you're going to be in a higher tax bracket, but you had some low income back in the previous 3 years, you can take a portion of that income, roll it back into those 3 years, take it out of the 23 income, get to a lower tax bracket, and possibly save some taxes. But again, something that only farmers can utilize. Constructive receipt. Some farmers, for example, will say, hey, I sold some grain here in December, just hold my check. I'll come in and pick it up in January. Well, if you could have picked up the check in December and just didn't do it, that's what the IRS would call constructive receipt of income. You got to report the income even though you didn't receive the cash. But the proper way to do it would be to have a deferred payment contract. And you're going to have a deferred payment contract with that elevator saying that there's no way that you can get that money until sometime in January, for example. But it has to be signed deferred payment contract to do that. You just can't say, hold my check and I'll pick it up later. Same thing is true for livestock or grain or any commodity that you may be selling. And again, here's where I talked about the deferred payment contracts. This is also a good way to have flexible year-end planning, because if you have sold grain on deferred payment contract, you like the price in December, but you don't want the income in December. So you sell it, you lock in the price, elevator gets the grain, it gets delivered. You're just going to get the check in January, for example. But you get to the end of December and say, oops, I made a mistake and I really could use more income. Maybe you're trying to use up those itemized or those standard deduction that you have. Well, you can pull back a contract and call it income in 23, even though you won't actually get the cash until 24. Again, it's a very good tax planning strategy. If you don't know where you're at, you can do this. The caveat is you have to pull back full contracts. You can't pull back just a portion of the contract. So you want to have multiple deferred payment contracts. Maybe they're 2,000 bushel contracts or 5,000 bushel contracts, whatever they may be, so that if you do need more income, you can pull back a contract to kind of try to help manage your income. Again, I have several people I've worked with that use this, and it works out very well. It only works for cash basis farmers. If you happen to be on an accrual basis, that does not work. I'm not going to talk too much about accrual unless somebody has some questions about it, but only works for cash basis farmers. The same would be true if you're trying to prepay expenses. That only works for cash basis farmers. So again, you're trying to avoid that constructive receipt. That's why you want to have that deferred payment contract. Something to consider here, though, be aware of who you're doing business with. If you just sell grain to an elevator and before you get your check, that grain goes for some reason bankrupt, and that has happened in the past for some grain elevators. Iowa has the Grain Indemnity Fund that you will receive maybe full payment or a partial payment for the grain that you delivered, just haven't received your check for yet. But if you have a deferred payment contract, currently anyway, those deferred payment contracts are not covered by the Grain Indemnity Fund. So you're only going to get money, whatever's left after the bankruptcy gets sorted out. It may be 10 cents on the dollar. So again, just be aware of who you're doing business with. The same could be true for prepaying expenses. If you're prepaying expenses and you pay, the co-op or whoever it may be, but you don't have delivery of the product yet, and they go belly up, you're going to be out there and hanging with the product, and the money's already spent. So be careful who that you do business with. Again, this just talks more about the deferred payment contracts. I talked about this already, but again, there is that risk that they're not covered by the Grain Indemnity Fund, although they're discussing that in this year's legislature for Iowa to also cover those deferred payment contracts. But so currently anyway, they are not covered. See what time it is here. I got 6:55 here, Lauren. I know we got some questions here. I had some examples here, but maybe it's better to try to get the questions answered and try to keep you down to your hour time frame here. So you got some questions.
Yeah, I haven't had any questions submitted in the chat, but I did put the Iowa Farmer's Guide to Iowa Taxes, the Sales Tax Exempt Certificate, and then I also put the Ag Decision Maker, their Legal and Taxes section.
Good. Something else, there's the Center for Ag and Law Taxation at Iowa State. Christine Tigran is a director of that, and a lot of issues that deal with taxes and EPA regulations and those type of things are posted on the Center for Agriculture Law and Taxation. It's an excellent website to go to if you got questions. Again, they have attorneys that you can call. A lot of people also call me. I kind of help them out with that websites for answering questions. But again, I think the important thing here to also remember is that no matter what you're doing, visit with somebody before you do it. Visit with your tax preparer before year end to see where you're at, because you can make some of those decisions, before the year end. Some of those even after. For example, depreciation. You don't have to decide what method you're going to use or what you're going, whether it's going to be Section 79 until you file your tax return. And again, farm tax returns, if you're considered to be a farmer, are due March 1. Unless you pay an estimate by January the 15th, then you can be extended to April 15th. That's if you're a qualified farmer. And again, you got to have 2/3 of your gross income coming from farming to be a qualified farmer. So if you have a good off-farm job and you're a small farm operation or just beginning farm starting up, you may not be considered to be a farmer yet. And so then your return is going to be due on April 15th. So again, but there's expertise out there. Make your contacts. And if you got questions, feel free to contact them or extension people also.